Hey everyone, welcome back to Finance on Fire. Today we're going to talk about the FIRE journey. What does FIRE actually stand for? Today we're going to talk about the 4% rule, the different types of FIRE, fat, lean, and coast, and we'll talk a little bit about the Monte Carlo analysis. Before we get started, I just want to let you know that I'm not a financial advisor. This is not financial advice, just some guy on YouTube documenting his personal journey. All right, let's get into it. So FIRE simply stands for Financially Independent Retire Early. The FIRE movement is about retiring early so that you can use your time to do what you love to do and enjoy to do. What has become really popular recently is that FIRE members are utilizing a guideline called the 4% rule to retire earlier than the average age of 65. 4% rule is based off of a Trinity Study, which is based off of Bill Bengen's financial analysis. What the Trinity Study tried to identify through analysis was what was a safe withdrawal rate. What they concluded was that if you withdrew only 4% of your retirement funds, you have a 95% chance of success of your retirement fund lasting for at least 30 years. If you take a look at a chart, you will see that stock-heavy allocations fared a lot better. Now keep in mind this data was only analyzed from retirees from 1926 to about 1980. Some nice person called Poor Swiss updated the Trinity studies to reflect the numbers from 1871 to 2020. As you can see, if you have 100% stock allocation, your 4% rule still gives you above a 95% chance of success of lasting 30 years. Anytime you divvy up your allocations, if you have less stocks than bonds, then the success rate actually drops a little bit. Take it for what it is. I'll put the link down below. If you want to take a look at what Bill Bengen's allocations were, he recommended 50% bonds, 50% stocks, 30% in S&P 500, and 20% in small caps. From 1926 to 1980, the Trinity Study only failed 1 of 2 years. If you retired in that specific year, then the safe withdrawal rate of 4% would not apply. The inventor says it was inflation more than the bear markets in stocks and bonds that really crushed retirees in the early 1970s. He says inflation is worse for retirees than bear markets because bear markets eventually end and stocks and bonds recover as they always do. Higher prices once they ride never go back to where they were before. Yes, like these dang Pokemon cards. When you get inflation, it gets locked in and you're stuck with the higher price for 30 years. Oh my gosh. For the 4% rule to stand the test of time today, the inventor says the worst case scenario would be to incorporate a renewed bout of inflation. The FIRE members popularized this 4% rule so much that it became more of a rule than actually what it was supposed to be, which was a guideline. And the reason it should be a guideline is because it doesn't count for taxes, it doesn't count for mutual fund management fees, and doesn't count for today's environment of low yield bonds. You might be saying, you know what, I'm doing 100% stock allocation, no bonds, so don't worry about the low yield bonds, and I'm going to do f.I.r.e, which is a 0% ETF that covers the entire market. Hey, you might be able to use this plan for your FIRE journey. A lot of FIRE members today reverse engineer this 4% rule to make it fit their retirement needs. If you want to retire with $100,000 a year of income, you will need $2.5 million in your retirement funds. Now that we know the math, we just need to decide which part of the FIRE journey you want to be a part of. You want to be fat FIRE, lean FIRE, or coast FIRE. Fat FIRE sounds really interesting, but really it's just living 100% of the lifestyle that you have now, the same as you would in retirement. Most retired people will downsize or reduce their spending dramatically, but not fat FIRE people. They want the same lifestyle, fancy cars, 5 vacations a year, and live in a gorgeous city, fancy meals, all the toppings. And by toppings, yes, I mean that it allows you to budget for kids as well. One of the financial people I deeply respect who actually lives here in San Francisco is Financial Samurai. He's pretty much a fat FIRE member. He promotes fat FIRE, although he doesn't really refer to it as fat FIRE. He just calls it being financially smart and financially independent. He promotes a 0.5% safe withdrawal rate. So not 4%, 0.5%. He recommends taking your annual expenses and not doing a 25 multiple, but a 200 time multiple. Applying the 200 times multiple to your $100,000 retirement income per year, that means you would need to save $20 million based on the Financial Samurai guidelines. A lot of you hearing that might say, you know what, forget this FIRE journey, it sucks, but really it's up to you. You don't have to go for a 0.5% withdrawal rate. You can do the 4% guideline. You can do somewhere in the middle. You can really do anything you want. Most people stick with the 4% withdrawal rate because that's what most people do, but it's up to you. Lean FIRE is exactly what it sounds like. Very lean, low cost type of living. You reduce your yearly income as you retire. That means smaller house, renting. Most people don't own with their lean FIRE. They sometimes do global arbitrage or global hacking to live a quarter of a year or half the year somewhere else to reduce their spending or living expenses. They also need government aid or subsidies for health insurance for them and their family. They'll most likely have a side hustle. Most of them don't have kids. Personally, I'm only on my year 1 of my FIRE journey. I haven't even retired yet. However, Financial Samurai, he's been retired a long time, since the early 2000s. And he said that in Fat Fire and Lean Fire, he has yet to meet someone in fire, meaning they've retired, without a side hustle, meaning that everyone's still side hustling. And personally, I believe that's what it should be. It's not you're retiring on a beach drinking coconuts. I mean, you could do that, but I really believe it's doing what you love with your time. And lastly, I don't know who made this up, but there is something called coast fire. And that means investing enough for retirement only. You take the same 4% rule or 0.5% rule, whatever rule you like, you apply it to your retirement income that you would like at whatever age it is, let's say it's 65, and you shoot for that goal. Once you have saved enough into that investment account, then you no longer need income to save. You only need income to live. In that way, you're hitting the first part of FIRE, which is you're hitting financial independence at a later stage. However, retiring early means that you still have to work for a living. So I don't know if this can be really called coast FIRE. It should be called coast f.I.r.e, which means financially independence in retirement only, because you're definitely not retiring early. There you have it. Once you analyze your FIRE goal, which is your retirement yearly income and the target age you want to retire, you can start formulating an investment strategy around that. A lot of it's predicated on the income that you make today. If you forecast that out for the age that you want to retire, whether it be 10, 20, 30 years, you can start allocating your savings and investments for that goal. Most people in this community want to retire early. So they have an aggressive investment allocation or percentage. About 70% of the income is utilized towards investing. Personally, I'm only at 50 to 60%. I'm still shooting for that 70% myself. There's a lot of blogs out there that will teach you about allocations, which stocks to buy, which ETFs to buy. I'll put some down on the link below, but really you can't go wrong with just getting started. Buy an ETF, buy a bond. I'm not going to get into what you should invest into in this video, because that could just be a whole 10-week series itself. I will say don't buy GameStop and Bitcoin, even though it's skyrocketing. What most FIRE members adopt is just a safe investment strategy. By safe, I mean boring, low-cost ETFs, bonds, mutual funds maybe, and some REITs. FIRE members tend to find tax-advantaged savings accounts like a Roth IRA, traditional IRA, or 401k. And due to these tax savings accounts, they're able to squeeze out a little bit higher percentage in savings and compound their investments a lot more. What makes FIRE great for the average person is that it takes understanding stocks out of the equation, because you're buying the entire market and you're buying safe municipal bonds or state bonds or federal bonds. You don't need to read earnings report. You don't need to have, understanding of charts, things of that nature. You're buying the entire market. And historically, the market has gone up after every big dip. A typical recovery after a big recession is 2.5 years, some lasting even as long as 5 years. If you're a true FIRE member, you understand this. You buy into the storm, you rebalance, you reallocate. When bonds are high, you buy stocks. When stocks are high, you buy some more bonds, and you constantly rebalance until you get the allocation that you want. Another great thing I like about FIRE is that it takes anxiety out of investing. If you're watching this in 2021, that means that Wall Street Bets has just skyrocketed the price of GameStop. If you're sitting on the sidelines, you probably want to get in because you feel like you're missing out on a lot of gains. That's called FOMOing, fear of missing out. Because I've been part of the FIRE journey for 1 year, I never feel like I'm missing out because my portfolio is always growing. Although it's at a snail pace of about 7% average per year, it's growing, I'm not losing. If I told you you're going to go into a casino and you're never going to lose, you put money down, but you're only going to get 7% of return on every hand, would you play? Hell yes, you would play. You would put money. The more money you got, you put in there. 7%, I can't lose. I'm just going to get 7% every time. I'm not going to lose. I'm going to hit blackjack every time. Take all my money. And really, that's what the FIRE journeys preach. You invest in the overall stock market. Average return for the history of the stock market is 7%. The one downside about the FIRE journey is that they are heavily invested only into stocks, right? But their belief is that if the stocks fall, right, and plummet down to nothing, then we have bigger things to worry about. Because even if you're holding real estate and the stock market plummets to near zero, which would never ever happen, something's going on. Aliens are invading us. Things are happening. And no matter how diversified you are, you're not safe. So that's their general understanding or the truth that they stand by. If you follow Financial Samurai, he has a lot different belief. He believes in diversification, getting some real estate. You want to get into your own business. You want to have investments only as a small part of your allocation. So it's completely different than just the FIRE members who invest solely in the stock market. Remember, FIRE is about financially independence, retiring early. It's not about the 4% rule. 4% rule is just a guideline for FIRE members. So every which way that you choose to retire early is the right way for you, because everyone's different. Some people can global arbitrage, live in Thailand for half a year. Some people cannot do that. They want to live close to their family in a big city. There's no set plan for one person. That's why it's so hard for any YouTuber to come on here and say, hey, here's what your allocation should be. Here's how diversified you should be. It's really up to your standards of living when you want to retire. The 4% rule being a guideline has been tested many times. There's a lot of theories on it. It's been revised in 2009, and there's been no change in the success rate. However, with technology and computer analysis that we have today, a lot of people utilize a Monte Carlo analysis, which is the 4% rule on steroids. What's a Monte Carlo analysis? I can't remember it, so let's read it together. This is a quantitative analysis of risk. Say that 10 times fast. The Monte Carlo performs risk analysis by building models of possible returns by substituting a range of values, a probability distribution, for any factor that has inherent uncertainty. It then calculates the results over and over, each time using a different set of random values from the probability functions, aka guessing a lot. Joking aside, is basically making assumptions at every single level with real-time data. Let's jump into how that looks like when applied to an actual portfolio. I'm not sponsored by Personal Capital, but I like that it's free and it's really easy to use. Personal Capital has a free tool called Retirement Planner. Just click on that. What they do is they take your investment assets and run the Monte Carlo analysis on your portfolio. In a more complicated way of saying things, they run 5,000 Monte Carlo simulations to deliver a robust and personalized retirement projection. What they do is basically take what you've spent, what you're investing in, what you're going to make, inflation, all of that metrics, and dump it in for you. You don't have to calculate and do an Excel spreadsheet yourself and spit you out a number. It's pretty customizable. When I first started this, it said I was way off a track. I put in my numbers and they're like, you're not going to retire pretty much. After 1 year of the FIRE journey, improving my investment accounts, it actually says I'm on target now. I'm on target based on their assumptions. They're seeing what I've spent in the last couple of years, and they say that my monthly spending is about $2,000 a month, which is about $24,000 a year. I put in that I want to retire in 10 years, so about 48 years old. They also assumed that I would decrease my spending about 1% per year. I'm going to let them stick with that assumption. I'll change that later on. You can also change assumptions because you're not going to be in a 20% tax rate if you're only making $24,000 a year. That'll probably drop. Inflation rate, 3.5%. I think is a little bit above the norm, but let's just leave it at what Personal Capital have. And life expectancy 92, maybe I should bump it up to like 120. You can put Social Security as another assumption for retirement planning. Most FIRE members won't bank on Social Security. They call it Social Security. That's why they created their own plan. But you could put this in here for analysis purposes. This actually only takes place at 65 years old, so it's completely out of the calculations for my retirement age of 48 years old anyways. And this is probably the most important part. You got to put in all your savings, as it might not all be in Personal Capital. So put in my savings, put in what you're going to save every single year, and if that's going to increase every single year, well, you have to put that all in there. Basically, after you put in your income events, which is your savings, Social Security, and then your spending goals, your retirement spending, and some of the assumptions, which is the inflation, your tax bracket, things like that, it'll spit you out a projection of where they think you're going to be. For me, they project that with my savings rate and investments, I would have $788,000 at the age of 48 years old. Now, to me, that's a little bit incorrect because when I put my total savings, that's including my real estate investments, which you really can't calculate through the Personal Capital Monte Carlo analysis because that's my investments in syndications. And those returns are different every single year. A lot of time it beats the market. Actually, most of the time, 99% of the time, it beats market returns. So that number hopefully will be a little bit higher. Now, these assumptions are way off than my projected retirement income that I want for myself. It's only saying $24,000. Personally, I like a $40,000 minimum withdrawal, which means that I'm on track based off of Personal Capital assumptions of the Monte Carlo analysis, but that doesn't take into full account of my personal goals, right? So let's change it up a little bit. Let's go to retirement spending. Change this from the estimate that they put that I've spent in the last, 2 or 3 years and change that up because I'm gonna have kids, right? Let's change it up to $3,500 a month, which is about $42,000 a year, and let's save that. And bam, success rate 0. My projected portfolio is still around $788,000, but because I have a higher withdrawal rate, I'm not gonna succeed. I'm not even gonna last until, what's it say there? I'll last until 74 years old. So see you guys later. If I want to make this portfolio last a little bit longer with a safer withdrawal rate, then what I have to do is to save a little bit more and actually work out the assumptions a little bit different. As we mentioned earlier, this model is not really correct because it's taking into account my real estate portfolio as it stands today, which historically has a different return than a stock market. So it doesn't really apply that in here. So my success rate is not really, 74 and I'm done. It's probably a lot higher than that. I forecast that out in my previous Excel spreadsheets if you've taken a look at it. And in my next video, I'm going to show you my personal Roth conversion ladder so you can see what I'm looking to withdraw. What I'm trying to say is that the Monte Carlo analysis sucks, which is completely wrong. It doesn't suck. It's just taking what they do know, which is data, and applying it for the future. What they don't know is that kids are going to come pop up, and also my real estate returns and other projects that I have in the works as well. This is something that I will manually input the numbers year after year to see how my projections look. So I would say that the Monte Carlo analysis is really correct, but you have to check it every single year with updated, fresh data. All right, everyone, I hope you enjoyed today's video. I really hope that you yourself get into the FIRE journey. As a basic understanding of investment, I think FIRE journey is the best path you can take. Personally, for me, from 2019 to 2021, it's helped me increase my portfolio over 100%. If you want to learn more about the FIRE movement and the successful people within it, click on my links down below. If you want to follow me, my fiance's journey of FIRE, we're in year 1, approaching year 2, and we'll show you our results and our portfolio as we go along the way. If you have any questions, please comment down below. If there's any topics that you want me to dive deep into, please let me know. Until next week, guys, stay healthy and stay FIRE.